Hi, I'm Thad Welch. I'm a portfolio manager here at St. Germain. With everything going on in the markets and the volatility, we figured this was a good time to reach out to you and give you some of our thoughts on what we're thinking and how we see things progressing. We've talked a bit about in our writings and some of our other missives that volatility is normal, and we've gone through a long period where we haven't had any, and really all that's done is changed our perception of what volatility is. It's kind of like having a stretch of very warm weather and then all of a sudden it dropping into the 50s and it feels freezing, but it's really very normal. And right now, being in New England, if we had a 50-degree day, it would feel quite comfortable. We'd be more than welcome to have a 50-degree day at this point. But when you have that perception that things are very calm in the markets and all of a sudden it returns to kind of a normal swinging volatility state, it can be a bit shocking, and that's really what we've seen is a change in perception and not necessarily a change in how the markets are reacting. To put some perspective on it, year to date as we're filming this, the S&P 500 is down 0.1%. So even though the markets have been volatile and intraday the swings have been quite large, we're really not seeing a big impact on the total return. Down 1% is negligible, and it's really coming off of, in January we saw what was a really unsustainable run up in the market where we're up about 6%. This was coming off the back of last year, we're up over 20%. That really, there's nothing that indicated that the market should continue at that clip, going 6% in just 1 month. After that tremendous return we had last year, was just pushing valuations to the extreme, and we really had to see some sort of correction to come back where earnings and fundamentals of the economy are driving it. So that's really where the volatility began, and that's kind of where it's ending, is where it's coming back in line with the fundamentals. And even though the markets can swing intraday and be irrational in any given week, the fundamentals of the economy are not like that. They don't go hand in hand. So what's going on in the market does not mean that that's what's happening in the economy. So the markets may be going through these swings, but the fundamentals of the economy are still progressing. And that's the thing that we're really looking at, is what are the underlying trends of the economy, of earnings, of corporations, and that is what will eventually drive the market and where the market will kind of settle out and move along with the fundamentals. And we want to see those move together and not see the market get ahead of itself like it did. So that's kind of where we're seeing them come back in lockstep, and we do think the fundamentals are quite strong. We look at a number of different indicators that are all pointing to continued progression. There's certainly some cause for concern in a few areas, but we don't see anything that's major out there that really is getting us to move to the sidelines. One of the variables that we do like to look at is it's a shape of the yield curve, because historically it's been a very good predictor of when recessions are coming. The last 7 recessions have been preceded by an inverted yield curve. So obviously it has a good track record to it. Doesn't mean that it's always going to happen. But the yield curve is flattening, and you can actually run a probability on it. And right now it's saying there's about a 10% probability, based on the way the yield curve is shaped, that we'll have a recession within the next 12 months. We don't like to make a bold prediction on the macro economy and what will happen, but a 10% odds of a recession seems reasonable to us, and we think that is probably a good base to use, that maybe there's a 10% recession. Put it another way, there's a 90% chance that the economy is going to be just fine throughout the course of this year. We are still in a slow growth environment, and we'd expect that to continue. But with an economy that is fundamentally sound, that does provide some protection to the stock market, where the biggest drawdowns are going to come during times where there is economic stress, obviously a recession being one. So 10% probability seems reasonable. That gives us an opportunity to continue to look for investments that are reasonably valued and have potential to grow. And we're continuing to look around for those. However, one of the things, as I was saying before, is looking at the trends. Is the trends are getting pretty long. We're decently long into this economic cycle, and even looking at the trends on this chart of the Treasury spreads, they have increased. We went from almost a 0% probability, judged by this variable, of having a recession, 0% chance, to about 2% over the last couple of years, and now we're up to about 10%. So obviously still very low, but it is trending higher, and that is because the economy has come a very long way since the recession, and naturally as unemployment becomes very low, as valuations continue to go up, as corporate profits continue to get towards peak. The next step would be to kind of slowly go down. That does provide a little reason why we're being more cautious than we typically would be, because this is just is a time to be cautious based on valuations in the economic cycle. So we still think the economy is fundamentally sound. Volatility is not disturbing us by any means, and we're continuing to look at the underlying variables and the trends.